this ongoing series, we will be building a diversified total return TFSA all the way from 0 to 100K. Hold on to your portfolios, folks. This is going to be a good one. We began several months ago with that first $400 deposit to begin a brand new TFSA. We will, of course, be adding another $400 this month for a total of $1,600 invested thus far in this new TFSA. With every month, we get one step closer to moving that dial from 0 to 100K. After that very red September, we had higher hopes for October, but those expectations certainly fizzled as October continued in a very red trend. The word recession has been coming up a lot in the financial media, and although we are not officially in a recession, you sure can make an argument that we may be in an unofficial one. Whether or not that is the case, a recession, a bear market, or even just a prolonged red period is good overall for this challenge. All the stocks I am currently buying at a discounted price will add up big time on the other side as we move towards the challenge goals. This is true for all long-term investors. While the market is down, you are buying future returns, and despite seeing those red numbers or a fall in your overall portfolio value, these are the stocks that will recover on the other side and flush that same portfolio into some green territory and push that portfolio value way up. Join the conversation. Let us know in the comments your biggest challenge when it comes to motivating yourself through these red months. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. As this series progresses, we will be adding new statistics and beefing up the ones we already have. This is going to be simply awesome. This time around, we added another $400 and, well, 27 cents to our portfolio. The 27 cents came from me being, well, short that amount for a stock, and I just wanted to have it, so I threw in that extra 27 cents. We will start by looking at our current lineup and any changes that we have made to them. We will start with Scotiabank, and this time around, we did buy one more share to bring our total up to 3 shares. So they have an average cost base now of $63.25. We've received $3.18 in dividends, so that gives us a return on investment of negative 12.40%, total return of a negative 11.14%. With the bank still dropping, that means their dividend yield is going the opposite direction. It is going up. And right now, it's now at 7.652%. Our next Scotiabank dividends should be coming out around the end of January. But I tell you, this yield keeps getting better and better. Our next stock was Brookfield Asset Management. We did purchase an additional share, which brings us up to a 4-share total. They have an average cost base now of $45.74. We have received 87 cents in dividends from them thus far. Their return on investment comes in at negative 12.13%, and we have a total return after we factor in that dividend of negative 11.66%. Their yield is hovering around 4.276%. We do have some dividends expected from them around the end of December. We did not add anything to our next position, which is CNR, so it still sits at just a single share. The average cost base still sitting at $152.08. We've received 79 cents in dividends, so their return on investment is negative 3.04%, and we get a total return of negative 2.52%. Their yield is currently sitting at 2.136%, and we're expecting, their next dividends to drop right around the end of December. Up next, we have our good old friend Canoe, and we did not add any shares, so we're still sitting at 10 shares in total. Their average cost base still sitting at $13.01. We have received $1 in divs, so their return on investment currently sits at negative 5.53%, and we do have a total return of negative 4.77%. Their yield looking pretty nice at 9.764%, and this is one of our monthly payers, so that's always fun to see some consistent income coming in. Their next dividends will be coming up in about 2 weeks, around the 15th of November. That takes us to Canadian Natural Resources. We did not add any more to our CNQ position, and it still sits at 2 shares. They have an average cost base of $81.95. We've received $1.80 so far in their dividends. They are one of the shining lights in our portfolio with a return on investment of 7.38%. Add in those dividends and we get a total return of 8.48%. Their yield sitting steady at 4.091%, and their next dividends should come early in the new year. The next stock is Decisive Dividend Corporation. We did not add any more shares this time, so we're still sitting at 16. Their average cost base is still at $8.56. We have so far received $1.08 in dividends, so their return on investment, it actually improved a little bit, negative 12.62%. Adding in the dividends, we do get a total return of negative 11.82%. They absolutely did improve in October, but was it enough to get them out of the toad position? You're going to have to stick around to find that out. Their yield, once again, another one of my monthly ones, comes in at a nice looking 6.478%, and we're expecting dividends from these guys right around the middle of November. Fortis is up next, and we are still sitting steady at 2 shares. That gives us an average cost base of $55.17. We have not yet received any dividends, so their return on investment and their total return is going to be the same, and that's at negative 0.33%. They actually didn't do that bad in October. Yield-wise, we got 4.292%, and we are expecting dividends early December. As we mentioned last time with this dividend, they will have raised those dividends for their 50th consecutive year, making them Canada's second dividend king. So that's another exciting part at the beginning of December. The next stock is Hammond Manufacturing, and we did add 3 more shares this time around, which takes us up to a total of 14 shares. Their average cost base, that rose to $7.49. We have received 18 cents in dividends so far, so that gives us a return on investment of 26.03% and a total return of 26.21%. Holy banana bread. Their yield comes in at 0.636%, and they are the only semi-annual dividend payer we have in our portfolio. Those next dividends from Hammond should be coming out around the end of February. So even with that October that we had, this isn't one of the few stocks that still increased their return on investment. Very impressive. We added 2 more shares to Sir Royalty for a total of 8 shares. They have an average cost base of $16.44, and so far in dividends we've received $1.14, so their return on investment is at negative 1.64%. Adding in those dividends, we do get a total return of negative 0.78%. Their yield, another nice one, 7.05%, and it is a monthly yield, so you gotta love that. I should be receiving the next set of dividends from these guys, well, tomorrow. So these are the stocks that we already had in our new TFSA. We, of course, like normal, we added another 2 new positions. The first of the new stocks is Alimentation Couche-Tard, and we opened a position with 2 shares. That gives us a starting average cost base of $74.34. Their yield, not that big, 0.769%. They are a quarterly payer, and we are going to get some dividends around the end of December with these guys. Of course, if you did watch the recent deep dive I did on these guys, you know I've got a lot of faith in this one. Okay, we added also a second position, and that was in Open Text with the addition of 2 shares to get us started. They're going to start off with an average cost base of $47.03. No dividends, no returns, all of that yet. Their yield does come in at 2.963%, and we're of course expecting that first dividend around the end of December. This gives us a footing in the tech sector. Let's take a quick look at all of them together so we can see that portfolio beginning to take shape. You will notice that for the 1,600 currently invested, the portfolio only has a market value of $1,552.19. And as we said earlier, with back-to-back red months, we expected this to be down. Another thing that you may catch here is that the total book value is $1,607.33. That is because of the dividends being reinvested. So the book value will grow every month in addition to the 400 I am dropping in as those dividends start to roll in. Let's take a quick look at the portfolio's diversification. Using that fantastic app over at Blossom, we can get a diversification breakdown. Currently, we are still a wee bit heavy on industrials at 29%, and financials are also a little on the high side at 28.6%. They have both come down, which is good, because ideally I do want to see those guys come down to about 20%. Energy is coming in at 14%, which looks okay, but it may be an opportunity to add more in the next update. We also have consumer cyclical at 10.9%, and that's mostly thanks to adding Alimentation Couche-Tard. We have utilities at 9.5%, and Technology's coming in at a 6.3% with the addition, of course, of open text. Healthcare came in at 1.4%, materials at 1.1%, consumer staples at 0.7%, communications at 0.2%, and real estate. Well, real estate scraping the bottom at 0.1%. Honestly, I'm okay with keeping real estate down for now. Next month's selections will absolutely be taking these numbers that we just looked at into consideration. And as always, that second number in orange, that's the average across all the Blossom users, so you can see how far I am off from some of those averages. It is time to look at the toad and the goat of the portfolio for the last month. The toad award was a close one this month. The Scotiabank fell below decisive dividend, but then at the last minute, moved up just above them, and for that third straight month, that toad award goes to decisive dividend with a total return of negative 11.82%. And now for that coveted goat award, and this month it goes once again to Hammond Manufacturing with a kick-butt total return of 26.21%. They are still rocking this portfolio, and at this point, I am not seeing them losing the title anytime soon. So that is our update for this month. We will be back here again next month to do it all over again. I sure am looking forward to buying the next batch. Keep the learning going. Watch my video on tax loss harvesting or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.